Previously, we have covered how a stock exchange works and the process to invest. Now, we will see the two different approaches of investing, that is, growth investing and value investing. Beginning with growth investing, it is an approach in which the investors expect a particular company to grow at a faster rate than others. Their future growth prospects attract potential investors. These companies are fundamentally and financially sound and outpace competitors with innovative product offerings and strategies. Growth stocks have a healthy earnings growth, and profits or revenues are generally expected to grow at the same rate in future as well. While growth stocks do possess potential, it is important to note that they are also considered to be more volatile and sensitive to price fluctuations based on market sentiments and negative news. Zerodha is an excellent example of a successful company dominant in its business. Zerodha is continuously winning market share from its competitors and is adding new customers as the market is growing. The growth is completely evident in its revenues and net profits year-on-year trends. Generally, companies in the early stage of their business life cycle tend to display more growth characteristics than the companies in the later stage of their business life cycle. The premise of value investing is that the market will recognize the true value of such companies with time, and then the price will catch up, resulting in substantial profits. However, value stocks exhibit lesser price fluctuations. Apple is a great example, as it has traditionally been categorized as a growth company, but in recent years it has started to display more and more value stock characteristics. So, after understanding about these two approaches of investing, we will now focus on how they differ from each other in terms of fundamentals and other factors. Let's begin with current ratio. It is calculated as current asset divided by current liabilities. It helps to assess whether the company under consideration has enough resources or ability to pay its short-term liabilities. A higher current ratio is expected for growth companies, which should be above 1.5, and a lower one for value companies. Coming on to the next factor, that is return on equity. It is calculated by dividing the net income of the company by its shareholders' equity. This is of prime importance to know the return the company is generating on its equity, and it is also seen as a measure of its growth. A ROE of 15% or higher works well in Indian context. Next up we have earnings per share. Now, earnings per share is calculated as net profit after tax and preference dividend divided by the number of outstanding equity shares. As the name suggests, this ratio shows per share earnings that a company generates. Earnings per share will be used to calculate the next ratio, the price to earnings ratio. This ratio, calculated as current market price of the share divided by the earnings per share, may help you evaluate whether the company is overvalued or undervalued compared to its peers in the industry. Ideally, we look for companies where the PE is lesser than the peers for undervalued companies. For growth companies, PE ratio may not be a good indicator to compare. So, we can use our next ratio for growth companies. Our next ratio is price to earnings to growth ratio, also known as the PEG ratio. It is a company's price earnings ratio, that is PE ratio, divided by its earnings growth rate over a period of time. The PEG ratio adjusts the traditional PE ratio by taking into account the growth rate in earnings per share that are expected in the future. It is very useful in the context of growth stocks. Let's take an example. There are two companies, Company A and Company B, with PE ratio 50 and 40 with growth rate 10% and 4% respectively. If we will just decide on the basis of their PE ratio which company to go for, then we will definitely choose Company B. But if we take growth factor also, which is accounted by PEG ratio, then it will come out as 5 for Company A and 10 for Company B. So now we will choose Company A over Company B because a lower PEG ratio is better. So here we can see the difference in our selection because of the use of PEG ratio, which is a must for the growth stocks. Next up we have price to book value ratio. It is calculated as current market price of the share divided by the book value per share. The book value per share is a ratio that weighs stockholders' total equity against the number of shares outstanding and measures a company's total assets minus its total liabilities on a per share basis. Price to book value ratio indicates how expensive, reasonable, or cheap the stock is trading when compared to its book value amongst the peers in the industry. A PB ratio of below 1 is considered indicative of an undervalued stock. Some value investors and financial analysts also consider any value under 3 as a good PB ratio. However, the standard for good PB value varies across industries. Now we will learn about what is dividend yield and how it affects the growth and value investing. So, the dividend yield expressed as a percentage is a financial ratio, dividend upon price, that shows how much a company pays out in dividends each year relative to its stock price. Investors use the dividend yield formula to compute the cash flows they are generating from their investment in stocks. In other words, investors want to know how much dividends they are getting for every rupee that the stock is worth. As a value investor, it is important to select companies with a good dividend track record because investing in an undervalued company may mean waiting for a considerable period to reap its full return potential. But when the focus is on growth, the company may not necessarily declare attractive dividend because even its profitability year on year may be remarkable. The company may reinvest earnings back into their business for future growth, organic or inorganic. The last factor which we will consider is risk. Growth stocks are a bit riskier than the value stocks, as companies in the early stage tend to fall in growth category, whereas value stocks mostly comprise of mature companies. Hence, value stocks are less risky due to more certainty about their future prospects. Now, irrespective of growth or value investing, an investor should always consider the following parameters: the sector and the industry in which the company operates. The company must have a sound business model and a sustainable source of revenues. Apart from profits of the company, there should be focus on a triple bottom line, that is, people, planet, and profits. A significant economic moat, which refers to the competitive advantage, is also not to be ignored. The moat of the company can be identified by its brand value, the patent it holds, the size of its operations, the market share, consumer loyalty, corporate governance and culture, etc. Besides, it is necessary to evaluate the management, understand how the capital is deployed, how shareholders are treated, and whether the management has been able to steer the growth of the company. Here, we end this video hoping that it would benefit the investors to distinguish between growth and value stocks, and they will invest in stocks following the different parameters discussed in the video. So, stay tuned to know more about the stock market and investing.